the dollar, I think, is likely to weaken over time. And I think people are seeing this. And of course, the other side of that situation is if the dollar weakens, gold goes better.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with silverdoctors.com and our co-host James Anderson from SD Bullion. And our guest today on the SD Weekly Metals and Markets Wrap is Alasdair MacLeod from Gold Money. Alasdair and James, thank you so much for joining us today.
My pleasure.
Thank you.
All right, well, why don't we start with you, Alasdair, and can you give us a quick wrap of the price action in the gold and silver markets this week?
Yes, we had a very strong Monday after a weak Friday, and after that, the market more or less backed and filled. But I think the overall performance was actually quite encouraging. The active contract, which is December, is now running off the board in this month. And consequently, people have been rolling positions rather than taking in new positions. So the increase in volume on COMEX that we have seen, I think, really reflects that. But overall, I think the performance has actually been quite encouraging. Bear in mind that at this time of year, we are running up towards December, and in December, the bullion banks like to have prices low at the very least. So we're not immune to the bullion banks having another attempt at knocking back prices. But it seems to me that there is a new factor, and that is the dollar has had a reasonable rally. But I think it is quite clear to everybody in the currency markets that the dollar actually is in a bear market now, because if you just look at the relative economic prospects for America compared with the other major nations, particularly the Eurozone, you can see the Eurozone is picking up actually quite sharply. This is something that is rather absent in America. America is a rather sort of stagflationary situation, perhaps. And so on that basis, the dollar, I think, is likely to weaken over time. And I think people are seeing this. And of course, the other side of that situation is if the dollar weakens, gold goes better. And very often throughout this year, we have seen that it's just literally dollar weak, gold strong, dollar strong, gold weak. You know, they just sort of seem to be moving in tandem for a lot of the time. So I think that the prospects for December are interesting. I suspect that unlike December last year and December the year before, when we had rate hikes, incidentally, in both those Decembers, I think that traders will be looking through the rate hike and they will be looking at where is the dollar going to go in 2018. And I think on that basis, the one thing that you would not do is sell your gold. So I think that probably explains why the market appears to be fairly firm underneath.
Hey, Alasdair, is there a situation you could see in the foreseeable future where you could see both the dollar and gold rising simultaneously?
Yes, I would see the gold and the dollar rising from time to time against the other currencies. Mm-hmm. But I think that's a rally in a bear market as far as the dollar is concerned. Mm-hmm. I mean, obviously, when you compare the dollar against commodities, that is a rather different situation. And again, from time to time, there will be moments when commodities correct, which basically means the purchasing power of the dollar at that moment in terms of raw materials might increase. But this is it's a very interesting point that you raise, because we have an enormous amount of disruption in the pipeline in the Middle East with the night of the long knives, if you like, in Saudi Arabia, and that looks like changing lots of balances of power. It looks like Lebanon might be driven into a war as the Saudis and the Israelis perhaps have another bash at getting rid of Hezbollah. There is a lot of disruption there, and we have actually seen the price of oil reflect the all this disruption beginning, and of course that could also continue. And under those circumstances, of course, the dollar is buying less oil, less energy, so the dollar, if you like, is weakening against a basket of commodities, and that again I think is potentially good for gold, because gold tends to maintain its purchasing power in measured against other commodities. So if the dollar is weak against oil, I think that is probably another positive as far as the gold price is concerned.
Now, you mentioned about Saudi Arabia, and I was interested in learning your perspective. Alasdair, could you expand a little bit on how you think this could impact the petrodollar?
There are so many moving parts to this. We no longer have one power dominating the region, but we have two and a half. America obviously is still around, and nobody ignores what she does. The Russians have taken control of the northern Shia crescent, by which I mean Hezbollah, Syria, and going through Kurdistan round to Iran. So that is another power. And then very quietly in the background, there is a third power, which is the other, the half of the two and a half, and that's China. This is very important because China has the resources to be able to come in and help people in the region. And this is an interesting point when you think in terms of the problem that Saudi Arabia has. Saudi Arabia effectively has run out of money. And I think this is to a large extent what the current disruption is about. You accuse people of corruption and then you steal their assets. And I think we're going to see that's the way it's going in the coming weeks. And that's going to give the regime in Saudi Arabia the liquidity that it needs. So all in all, I think that it's a very complex scene. I think that Prince Salman, it looks like he is trying to stoke up action against Hezbollah. Between that and the Yemen, you have got, as far as the internal political situation is concerned, targets outside that might unify people within Saudi Arabia. It could be that's what he's trying to do. You've also got Qatar. That's another moving part in all this. Qatar has now been driven rather into an alliance with Iran. And so all these moving parts are actually quite complex. But I think what it boils down to is that at the end of the day, China is going to go in there and say, how can we help? And I think that help might come in two ways. I think the first way it might come is we can help you by subscribing for 5% of Aramco. For whatever figure. It probably won't be $200 billion. It might be a figure closer to $100 billion, but at least it can be done. And the second thing is they'll say, well, since we're getting friendly and we're now shareholders in your wonderful oil company, perhaps what we ought to do is we ought to settle our oil trade in yuan. So I would fully expect Saudi Arabia to take yuan in payment for its oil, certainly from the new year, if not before. And this brings up another subject which has been quite contentious, and that is the proposed futures contract on the Shanghai Futures Exchange of oil for yuan. And of course, that can be then used for someone not touching the dollar at all to open another contract of yuan into gold. And they can do that in Hong Kong or Dubai. There is actually a contract in Dubai where they can do this deliverable. So what we're seeing is the position of the dollar being eroded actually very, very sharply in the first months of next year. Now, I wouldn't be surprised if this contract has been part of the discussions between President Trump and President Xi in their meeting over the last week. So, there is so much going on in this. I think it's a question of watch this space. I've just mentioned a few of the moving parts. There are others, I can assure you.
Yeah, just to mention others, I saw recently a headline: Russia had signed some arms deal with Saudi Arabia, and you had the king go over there for the first time, visiting Moscow. So you're right; there are other players, and it's very complex.
Yeah. Yes, that was a little while ago. I think it was last month that King Salman went over. Yeah, I mean, it was a sort of a lovely, showy deal. Everybody turned up. All the movers and shakers on both sides turned up, and it was all televised, and it was rather like two fingers to the United States, I think.
Now, I'd like to move our focus to the stock market, getting back to the markets. I know here in the United States, I think the stock market this week kind of was flat, but what is your perspective? I mean, I guess the longer term trend is that we keep seeing the stock market hitting all-time highs over and over. What is happening over in the UK with the stock market?
Well, if we look at the UK stock market, something like 70 to 80% of it actually is international companies in the FTSE. So as much as anything, we reflect, I suppose, two things. Firstly, the performance of international equities in the general sense, but also if you go to weak sterling, that is reflected in higher stock prices on the London Stock Exchange. So it's those two factors. It's difficult to know where we're going in the very short term for sterling. My guess is we are likely to weaken a bit because the negotiations in Brussels are running through a very, very difficult period. And we're getting to the stage where ultimatums are beginning to be given. We haven't quite seen that yet. But today, Theresa May made a very clear statement, and that is that she is going to put a vote to Parliament to the effect that we leave full stop, no ifs, no buts, in March 2019, which is the date when we're due to, when the 2 years notice is up. Now, I think this is an attempt, if you like, to get the message over to the EU negotiators that we are leaving, because behind everything that they're saying, look, we can't afford you to leave. If you're going to leave, pay us an awful lot of money. If you, but otherwise we would welcome you to stay. That's what they want. And you can see from the various comments that are made by various leaders around Europe, they really just don't believe that we are going. And furthermore, they think that the Theresa May government is so weak that it's likely to fall, and therefore they can pressure us, if you like, into staying one way and another. They're reading that entirely wrong, but it does mean that in the coming weeks, there's going to be quite a lot of, I think, adverse publicity, which could be unsettling for sterling. So coming back to the market, that could actually drive our equity markets a bit higher, but that would be relative to other markets and just reflect, if you like, the decline of sterling.
Hey, Alasdair, one question on the stock market. I'm not sure I've ever seen you write about it, but as far as like the Dow Gold ratio, what is your long-term perspective on that? I mean, do you see it eventually reaching 1-to-1 at some point?
I don't know. I think probably yes. I mean, I would actually look at this question from a different angle, and that is, we are heading towards the circumstances that are likely to collapse fiat currencies. Now, whether it does it after the next credit crisis or we've got yet another credit crisis afterwards, we can argue all day about that. But let us assume that the next credit crisis is worse than the last one. And given that it's worse than the last one, what's likely to happen is that the amount of money that is produced by the central banks to keep the banking system open is going to be considerably greater than last time. Now, what this means is that the deposits that people have are going to be really quite enormous one way and another. I mean, already we're up to, I think if you look at the deposits, it's something like, I haven't got the figure off the top of my head, but it's something like $10 trillion or something. This is an awful lot of money, most of which is not used. It's not desired. People don't want necessarily to sit on cash. There is too much cash. So far from the next crisis producing the situation we had post-Lehman, where we suddenly thought, my God, we've got to have cash. This time, we've already got cash. So what I would see is a very strong possibility that there will be a sharp decline in the purchasing power of currencies. Now, if we call it hyperinflation, just bear in mind that under those circumstances, the number one thing you want is gold. The number two thing you want, probably, is bricks and mortar. The number three thing you probably want is securities, stocks, not bonds, but equity in things which actually are going to survive the severest form of economic catastrophe you can imagine. Those are probably gold mines, actually, but anyway, that's a slightly different point. So I think that's the order of events. So coming back to your question about the Dow gold ratio, I mean, basically, I think gold is going to go up a lot faster than the Dow under those circumstances. Though, I mean, you've only got to look at Zimbabwe. The best performing stock market in the world is the stock exchange in Harare. Yeah, but fine. The currency that it's performing in is not something that you'd want. It's going down faster than the market's going up. And I think that's likely to happen when the fiat currencies in the West really do start losing purchasing power after the next credit crisis.
Okay.
Now, regarding the credit crisis and eventual fiat currency collapse, I know, Alasdair, you recently wrote an article on this and how cryptocurrencies could affect both of these events. You talked about how if the cryptocurrency bubble lasts into the credit crisis, it could make it a lot worse. And after that, if it lasts beyond the credit crisis, it could also devalue fiat currencies. Can you expand on these points?
Yes. The first thing that we must acknowledge is that cryptocurrencies are not money. People dealing in cryptocurrencies believe they are money. They believe they're the replacement for fiat currency. A lot of them have turned around and said, well, actually, it's a replacement for gold. You know, if you want to hedge out of fiat currencies, then you have cryptocurrencies, not gold. That hedge will work, I'm sure, from time to time. But actually what we're seeing is not the invention of a new form of money, but a pure bubble. And it's more pure than any bubble we've ever seen. And more than that, when you look at the sort of the big bubbles in history, whether it was tulips or the South Sea bubble or the Mississippi bubble, of course, these were very localized. I mean, when you look at the South Sea bubble, for example, I would doubt that there were more than just a few tens of thousands of people directly participating in that bubble. Probably less than 10,000. But now, of course, we've got a very different situation. You've got the whole world. Anyone who's got a bank account and a mobile phone can go in and deal in cryptocurrencies. So this is a far bigger market. The other thing about it is that in those bad old days when you had the South Sea bubble, it was basically speculating with real money, mostly real money. And what this meant was that you had to take your gold and silver from being used for other things and spend it on buying shares in the Royal Exchange in those days. That, if you like, created shortages of money outside London, but of course it caused an inflation inside London. Now we have a situation which is completely different because the banking system just produces as much money as is needed to support the bubble all around the world. So this bubble, I think, I know that things like Bitcoin have gone from close to zero to $7,000. There have been lots of other cryptocurrencies, a few of which have got traction along with Bitcoin and all the rest of it. But it does seem to me that the potential for this bubble is considerably greater than anything we have seen before. But there will come a point, I think, where even without the normal credit crisis that we're that I think is in the works, and I think we can agree is in the works, there will come a point where the effect on the prices of ordinary goods and services from the inflation of prices in cryptocurrencies will begin to push prices up. And the reason for this is that when you've got a lot of people making money, they go out and they spend it. So you're going to find that suddenly you've got all this inflated asset value driving up prices. What do the central banks do? They then have actually no option but to try and control the cryptocurrency bubble. And they can only do that by raising rates in the fiat currencies. And the collapse of the cryptocurrency bubble could actually be enough to produce a huge, great economic winter globally. So this is, this is the way I think it should be looked at. You also mentioned the credit cycle. Of course, what I'm talking about in terms of a cryptocurrency bubble is likely to be longer in terms of time than perhaps the amount of time we have before the next normal credit crunch. Now, under those circumstances, assuming that the central banks work to keep the commercial banks open, then I see no reason why the cryptocurrency bubble can't continue, if you like, as an alternative to holding cash in the banks. And indeed, I think quite a lot of people believing that cryptocurrencies are money could well take the view that they're better off not having their money in the bank, but having it in cryptocurrencies. So in that sense, they'll be sort of replicating the in their minds, if you like, the holding gold as opposed to paper currencies. But the effect of that is ultimately going to collapse the value of paper currencies. Gold has seen this sort of thing all before, not this specific instance, obviously. But I mean, there have been attempts by governments to do away with gold. These attempts have always failed, and gold has always surfaced as the one true money accepted by everybody around the world. So this, I think, is something which is completely different from gold. Gold will be affected from time to time, but actually the real battle, I think, is between the cryptos and the fiat. And I think the cryptos could end up destabilizing the fiat currencies in a way we haven't seen before.
Yeah, one other point on Bitcoin. I mean, I don't know if you've looked, Alistair, before, but the amount of energy used currently to mine Bitcoin and to make it operate is staggering. And it's obviously just in the first, maybe second phase of its bull market, essentially. So, I mean, we probably haven't reached the mania just yet. As you mentioned, I think the mania may be ahead in the next credit crunch. So it'll be interesting to see, what it bumps up against as far as energy usage in the next downturn.
Yes, it's. I take the point entirely, and it's really about the relative expansion of bitcoins, which is, as you point out, now virtually zero, compared with the free expansion of fiat currency. Mm-hmm. That is really what drives, if you like, the demand for cryptocurrencies. Sure. And the lack of demand for paper currencies.
All right. Well, Alasdair MacLeod and James Anderson, we covered a lot of ground today. Thank you so much for joining us today. I guess starting with James, were there any other topics you'd like to discuss with Alasdair?
No, I think we covered them all. It's been a pleasure, and I really appreciate being involved in this discussion.
All right. And Alasdair, any last thoughts you'd like to add?
I think, as James said, I think we've covered quite a lot of ground, and it's probably best not to bore people by trying to cover more. But thank you very much indeed.
All right. This has been your SD Weekly Metals and Markets Wrap with Alasdair MacLeod from Gold Money and James Anderson from SD Bullion, and your host, Elijah Johnson from Silver Doctors. Thank you so much for joining us, James and Alasdair.
Thank you.